Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 21st of January, 2026. I'm Mark Gardner. Stocks were hit overnight as risk continued to pile up. That's a little bit confronting having a look at that market map. I don't think we've seen one of those. Unless you're red, green, colourblind, you haven't seen, one of those for quite some time. What it really is boiling down to is, Trump's tactic of effectively, lighting a fire to distract from another fire he started. Eventually ends up being, you're being surrounded by fires and the risks pile up way too much for the market to actually bear. Scott Bessent's come out overnight and said and blamed the Japanese bond yields, the 10-year JGBs. He's obviously just trying to distract from the fact that, they kidnapped a sovereign leader. They're talking about, they're talking about buying or invading Greenland and tariffs and et cetera, et cetera. So it sort of gets to the point where Trump's tactic of just continually announcing like major thing after major thing, it sort of becomes a little bit too much for the market overall. So we're going to cover the Japanese bond yields, and it's something that Jonathan Takadana has covered on Ausbiz, a little bit. And, even as an ex-bond trader, as much as I know it's, very important, it's pretty hard to get excited about. But if we go back to what the yen carry trade did back in August 2024, where we had that down 15% day in the Japanese stock market, yes, it bounced back. It was just an unwinding of the carry trade. But what we're saying here is like this is from 2014 to 2026, bond yields have basically been under 0.5% in Japan. Probably since the 90s, essentially. And what we've seen here now, again, and particularly this acceleration here in the last sort of 6 months, is, what the maths geeks call, well beyond a 3 standard deviation. I've heard anywhere up to a 6 standard deviation sort of move. So like once in a decade, or if not once in a couple of decades. It's like this, the severity of this move is like the 1% of the 1% sort of thing. If you're a maths guy, don't cringe at that analogy. I apologise. And the blue line here is the US bond yields, right? So what it really means for markets is Japan have been extraordinary savers forever. And because they've been getting zero interest rates in their own country for so long, they've had to export that money offshore to US stock markets or US treasury yields to get any form of return. So what it really means is that now the smaller this gap gets between US treasuries and Japanese treasuries, the more incentive there is for the Japanese investors in Japanese insurance companies, etc., which are some of the largest bondholders in the US, some of the largest equity investors. It incentivizes them to bring that money home. And they are a nationalistic bunch, and Trump by default is pushing the entire world towards a bit more nationalistic behaviour as well. So not that they needed too much encouragement, looking at that chart, but we've got obviously bond yields in the vicinity of 2.4. I think they were half that like a couple of months ago, basically. It's really unprecedented, and could trigger some money flow, which will pull the rug a little bit out of the US, potentially out of US equities and US bonds, meaning this will head a little bit higher as well, which is exactly what Trump doesn't want. And as an article I wrote yesterday, Trump's like a toddler with a gun at the moment. It's and you just hope that the safety's on and he tacos, because there's a lot going on. So I just need to explain why it matters. Japan is savers. Hired, and here's the finance speak for it, but shrink the equity risk premium. Yields are bank insurance tend to outperform. Blah blah blah. And domestic investors rotate from stocks into safer GGBs, which obviously withdraws the bid. So from a practical standpoint, as stock market investors, there is more incentive to be in bonds, so there's less flow, there's less of that passive flow, or the mindless green robot, as we call it here at MPC, with the ETF that just gets ploughed into 401ks and super balances. Starts to maybe get absorbed a little bit by some safer, higher government bond yields. So, for the first time in 20 years, bonds can start to compete a little bit. So I'm just going to do this risk list as well, because what I was just saying about just that, Trump's blitzkrieg tends to distract you from the fact that there is just like an enormous amount of just risks and major decisions and policy moves, etc., just piling up, right? So, I mean, forget about the 10% credit card thing. Forget about the housing policy, blah, blah, blah. They're sort of distractions. But, you've got the Supreme Court is still yet to decide on whether Trump overused his powers and whether it was legal to even impose tariffs, which, I mean, at this point, it would be such a disaster. I think that they either delay that decision as much as humanly possible, or they can really do nothing but side with Trump, to be honest, because unwinding it would be a categorical disaster. But they are supposed to be, most of them, or a couple of them, are appointed by Trump. The Republicans do have the sway there. But if they do their job to the letter of the law and don't, proceed to public pressure, there is a risk that, tariffs got to be returned, it all gets unwound. Supreme Court decision on Fed appointments, Lisa Cook's dismissal, Fed chair, not to mention the Department of Justice investigation into Fed Powell, your Fed chair and your president having a spat, and then we're only up to number 2 here, people, just bear that in mind. And then Greenland, EU-US relations, tariff wars. EU's talking about retaliatory tariffs. I believe the Denmark pension fund just withdrew their, was starting to sell their US treasuries. I don't know how big the Denmark pension fund is, but it was just a little tidbit that I heard in the room before. Trump said he's already taken 50 million barrels of crude from Venezuela. I mean, that's a lot. There could be fallout from that. There hasn't really been any, but I think the more Trump's pushing on Greenland, the more people feel free and feel a little bit more inclined to speak out against what he did, the kidnapping of sovereign nations leader, no matter whether he was supposedly a cartel leader or not. It's kind of, we haven't seen that sort of stuff since Second World War or the Cold War. And then one that just, again, so the government shutdown that they resolved leading into Thanksgiving, which was largely because there would have been a rebellion if planes weren't working and they couldn't get air traffic controllers, got kicked down the road to January 31st. So we're 10 days away from another vote on the government shutdown. Nothing was resolved in the last one. They just resolved to kick it down the road. So the people didn't, but he burned the Republican and Democratic parties, home bases to the ground, because there would have been an absolute just riots if people couldn't get home for Thanksgiving. So that'll be that's just yet again another government shutdown, and then obviously the Japanese bond yields triggering. I'm sure there's more, but we've only got 10 to 15. I'm trying to keep this to 10 to 15 minutes, basically. But I don't recall there being a list that significant and comprehensive. And not to mention the fact that, there could be a complete policy shift on just about anything tomorrow with Trump in power. So these are the equities. So SPY was down 1% or so. Obviously, Nikkei was down. A lot of this was sort of started in yesterday's day session. Hang Seng, Euro stocks down 0.4, Dow down 1, S&P and Nasdaq down 2%, Russell down 1, but still up for the week. And obviously precious metals. This just shows how volatile silver is. Just an hour's difference between when I download the prices for this bar chart and the settlement price. It was like 6%, but it was the official settlement, silver was up 6%, but from this time yesterday, about flat. Gold was up 2%. Copper drifted a little bit, but that's probably fair enough for industrial metals because this uncertainty is not good for them. Platinum was up 4%, but basically teetering on a fresh record high. Everything else is largely flat, so Bitcoin was down a little bit, but, I'm trying to stick to the main points today. Netflix reported overnight as well, down 5% in the aftermarket. Truth be told, I haven't had enough time to go through that this morning. I don't think in a market with a heat map as red as what it was this morning that it particularly matters, because I think the overall index move is just going to outweigh unless it knocks it out of the park. I promise I will catch up on that tomorrow, when hopefully we have a slightly less busy and slightly less risk prone thing that I've got to go and do research on. Tonight, Johnson & Johnson, Charles Schwab, Halliburton, it could be interesting as well. When the US knocks stuff down, Halliburton builds it back up. So, it'd be interesting to see, what's going on there. GE Aerospace could be interesting from a defence standpoint on Thursday, and Intel, Procter & Gamble. Intuitive Surgical and Freeport McMoran for copper on Thursday. So PCEs Friday, employment expected up 24,000, 4.4 in Australia here on Thursday. And that kind of wraps it up. Just as I say, just trying to keep it fairly short. Keep an eye out. We've got a couple of sort of little articles coming out today just on precious metals and, relative to, well, can it continue, where it is in the scheme of things, some historical context around, where these incredible moves in gold, silver and platinum are in terms of a historical context, etc. Just so you can kind of get a little bit of an idea on, is it too high to buy or which one to buy, etc. These will all be coming out on Mosaic. You can sign up for free, 1 month free trial, get all of our recommendations. A couple of the silver miners with the ASX Alpha bought recently have done extraordinarily well, so you'll be getting that in January. But also what you'll be getting is, with this trial is the broker chat. So if the market starts to fall, pick apart at the seams here, you'll have that ability to be able to tap us here at MPC, our experienced crew. And we can help you out sort of rebalancing your portfolio if you're concerned. You don't want to give away those gains from the last few years, that's for sure. And cash is a position sometimes because sometimes you don't need the stress. So follow us at MPC Markets, Spotify, YouTube, Apple Podcasts. Go to mpcmarkets.com.au/mosaic, and you can get all of our webinars as well at mpcmarkets.com.au/webinars. I think I've already ticked off a few of the key calls in the market outlook already. So get yourself your free copy and watch the webinar. That'll be all for today. We will chat again tomorrow. Thanks. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.